Hello and welcome to Ask Me for a Trend. I'm Josh Lipton, and for the next half hour, we are breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving right into. Wall Street still basking in the glow of a Fed rate cut. Across the board, all major indices did end the day higher today. Should investors make themselves at home with REITs in a post-Fed rate cut landscape? We're speaking with an expert on best plays in that space. And the Fed effect may have far-reaching impact, including on your personal finances. Taking a deep dive on what it all means for you. Well, real estate investment trusts, also known as REITs, are in focus with the Fed cutting interest rates by 25 basis points at its September FOMC meeting. Our next guest says lower rates are historically a tailwind for REITs, but it doesn't lift all boats equally. We're navigating how to play the sector with the Yahoo Finance playbook, and joining me now is Haendel St, Juste, senior REIT and home builders analyst at Mizuho Americas. Haendel, it is good to see you. So, you figure, Haendel, the Fed cuts, that's good news for REITs. Is it good news across the board, or no? You gotta pick your spots, particularly in the apartments and storage names that you know so very well.
Hey there. Well, thanks for having me. And yes, it's been an interesting year for REITs in the aftermath of Liberation Day, tariffs, slowing macro, and now rate cuts. So the REITs are up 4 or 5% a year, but they're still lagging the S&P by about 1,000 basis points. But we've seen a good amount of dispersion within REITs, with a longer duration, more defensive sectors like triple net and healthcare leading the way, while apartments, storage, and retail have lagged. And so, our work has shown that rate cuts can be good for REITs broadly, but there is, some distinction between the different subsectors on how they perform. And so, as you alluded to, yes, we think that, investors need to be a bit selective. We think long duration, triple net, spread investing subsectors that are more defensive will likely continue to be relative winners. We've seen the apartments and storage lag. There's been some concern about demand and a slowing macro, the consumer pricing power. And so I think you have to be a bit more selective among some of those subsectors.
So you got to stay selective, stay smart, do your homework. In apartments and storage, I am curious, Haendel, where do you see opportunity?
Absolutely. So I think broadly, I think in apartments, we're in the shoulder months where demand is weak. It's been a bit of a challenging year for apartment landlords. They haven't achieved the pricing power that they wanted. So on top of, the macro being a bit choppy, there's concerns about pricing power. But, here we are going into the slower time of year, and all eyes are on 26. And I think there's a couple names, Mid-America, MAA, Camden Property CPT, which are trading cheaper than peers, and which importantly have an inflection in their growth profiles into next year. And that's important because historically that inflection, that improving second derivative, tends to be a very positive indicator for future performance. So we like the setup. Supply is falling. Pricing power should be improving in the aftermath of that supply falling. And more importantly, the core growth prospects are improving into next year and should accelerate into 27.
When we talk apartments, Haendel, are there important regional differences and distinctions you would highlight?
Absolutely. So I think it's, certainly the national apartment market, tends to be viewed as one big behemoth, but, we're looking at regions and looking at cities, and, we see a recovery opportunity, and that recovery is important because, obviously the future growth potential, it suggests, and the Sun Belt is a region that's been overburdened with supply the last couple of years. That supply is coming down dramatically into next year. And there's a window here in 26 through 28 where there'll be below average supply. So we like to set up there over the next couple of years. But you got to be a bit more wary of the coastal markets. They've been really strong the last couple of years. The comps are tough. New York City is a strong apartment market, should be fine the next couple of years with low supply. But DC, you're concerned about Fed job cuts and Doge. Los Angeles showing some weakness broadly within that region. Boston is slowing a bit. So a few more of these coastal markets are slowing, but the best market in the country today is San Francisco. And as a result, we like a company named Essex Property Trust, ESS, which has about 40% of their cash flow exposure from San Francisco.
Haendel, let's say mortgage rates keep dropping and homes get more affordable. 30-year fix, I'm just looking here. Mortgage News Daily, 637. Let's say that kept dropping, Haendel. What would that mean for the apartment subsector?
Absolutely. So I think that's a great question, certainly one that we're getting from investors these days. And, one of the tailwinds for the apartment space the last couple of years for demand has been the unaffordability of housing. On average, it's about 50% more expensive nationally to own versus rent. In some of the coastal markets like San Francisco, New York, it may be even 2x. So with rates coming in, that has helped. The 30-year mortgage rate's gone from near 7 to close to 6.4. Rate cuts in the near term probably benefit more the shorter end of the curve. Inflation's sticky. I'm not sure the long end comes in really over the next few weeks, few months here. So something we're watching. But I think that rates today at 6.4 still a bit higher than where we think the sweet spot for a real increase in demand for home buying could be, and that could be closer to the 5 to 5.5% range. So think another 100 basis points of decline from here, which doesn't appear likely, but also think about what would need to happen for rates to decline that much more. Of a weak economy, consumer confidence would be low. So we're not even sure that if rates were to continue falling on the long end, that there would truly be a real shift in consumer demand for housing, because consumer confidence matters. And I'm not sure in that type of backdrop that I just described that there would be a strong amount of consumer confidence and demand for the for sale side of the housing market.
Is there, Haendel, I think you sort of hinted this before, is there a seasonality to that apartment subsector?
Absolutely. So think about when the weather's warmer, your kids are out of school, it's just an easier time for people to look in the spring and into the summer. So the time of year that apartments tend to work best tend to be from, call it March through June, July. And here we are in September heading into October, landlords tend to play more defense. So it's a better time of year to be shopping. You have more negotiability on your, in terms of some of the rates that you can get for apartments because there's less people looking. But the landlords are also savvy in that they also gear less of their expirations during these slower shoulder months. So, I think that there's a little bit of operational acumen on their part to make sure that there's not too much availability during these times of year. But yes, this time of year, rent tend to fall a little bit. There's less demand and landlords tend to play a bit more defense. So if you're looking for an apartment, you're better off getting a better deal in the fall and winter months. And
now finally, we've been talking apartments here. What about shopping centers? That's another sector I know you know very well. Any picks there, Haendel, you would emphasize? Consumer does seem to be hanging in there just based on the retail sales data we got this week.
Absolutely. So I think there's, it's a sector that, people tend to worry in a slowing macro. Obviously, there's been lots of chatter about, the consumer and their ability to spend and, just how stretched that consumer is. But there's been resilience, as you mentioned, in some of the retail sales. And shopping centers, remember, are catering to more of a defensive nature. Think grocers and more essential items. So there's more of a defensiveness to their retailer base. But also what's important is that there's really no supply. And so I think landlords have had pricing power. We see an opportunity for the stocks to continue to work near term because there's a meaningful amount of embedded growth from leases that have been signed that will start cash flowing over the next year. So you don't need a lot of external growth acquisitions to really generate that growth. So defensiveness with a steady, consistent cash flow growth profile of mid-single digits for next year, which is comparable to this year. And so we like a name Regency, REG, Brixmor, BRX, because they have the highest amount of grocer exposure. And as I mentioned before, that brings an element of defensiveness on top of the pricing power that landlords are benefiting from today.
Netskope making its NASDAQ debut on Thursday. The company pricing its U.S. IPO at 19 per share. Yahoo Finance's Julie Hyman caught up with the co-founder and CEO of Netskope to talk about its highly anticipated IPO.
If you look at what Netskope does, it redefines what's the biggest market in security, data and network security. And our whole purpose of the company is to let people say yes to cloud and AI. So instead of saying, no, you can't use ChatGPT, or yes, you can, and you worry about what happens with it, we give you the ability to say yes and put guardrails. You can use it, but you can't use it to query with sensitive data. So it's how in this modern world can I use cloud and AI in a secure way? That's ultimately what Netskope does.
So it's almost then a sort of filter on these kinds of chatbots?
Yeah, so think about 100,000 plus SaaS apps in the world, tens of thousands of AI and generative AI apps, billions of websites, many tens of thousands of applications customers, enterprises have built. We look at all of those. So as people access them in a company, we sell to organizations, we look at that traffic and say, well, okay, that is valid. This other part, where you're trying to, for example, take corporate data and put it in your personal Dropbox account, that's not allowed. You're sending Gemini something that says reformat this healthcare data, and it's a public LLM. You can't do that. And so it's around how do I let people in a company use the tools they want, yet protect the company from their data and protect against threats.
I'm curious, as AI evolves and more companies end up using more tailored models, right, or proprietary models, or software companies that provide agentic AI services, what role do you all then play in that kind of a scenario?
Yeah, absolutely. So for us, if you look at, we run one of the world's largest cloud networks, right? We have companies that are 500,000 users. All their traffic goes through us. You open your laptop, you take your phone out, you go to your office, that traffic goes through us. And we enable it and secure it and accelerate it. And so instead of just humans, what I foresee in the future is that over half of the traffic going to the internet will come from non-humans. It'll come from AI agents. It'll come from devices. And so the same thing that we have done for users, we are now doing for those, for AI agents, for devices. Make sure that they're communicating with only the right things, only with the right data, so that you protect the company. So
it's interesting, the timing of the IPO. We've seen the IPO windows finally kind of open up here. We've seen a handful of different offerings in the past couple of months, and things start to reaccelerate. So what do you all hope to achieve by doing it at this point in time? What are you planning to use the proceeds for?
Yeah, it's a great question. So just, as backdrop, I'll be here in 15 years. And so we have a philosophy at Netskope, go long, right? Don't just think about the quarter, think about what's happening in 3 or 5 years, skate to where the puck's going. And so in that landscape, when we think about going public, for us, it's awareness. We know that if we can get into a customer and they see what our platform does, they're gonna more often than not, 80+% of the time, buy it and they want it. But we need the awareness. We need the at-bats. Being public brings us that. It brings us the ability for these companies to instantly see, okay, Netskope, big player, 30% of the Fortune 100, 18% of Global 2000, solid company. And so it brings you that cred, it brings you that awareness. And for us, that is the single biggest reason that we're going public.
Sanjay, I got to ask you the question that I ask everybody who's coming public, which is, when are you guys going to turn a profit? Because as you said, you've been there a while, you've got playing the long game, but you guys are still not profitable. When might that happen?
So just, if you take a step back, we are cash flow positive. And you've seen our margins inflect as well to the mid-70s. We had 20+ points of operating margin improvement. And so it'll follow. With hitting cash flow positive now, our operating margin will follow. We have a durable long model. We just put a massive amount on our balance sheet as a cash flow company. And so it's a great thing for us, and the op margin will follow.
Do you have any idea when?
We're not giving guidance right now. Mm-hmm. So that's one of the things about being public. you have to wait. And so perhaps later.
The three major indices hit records as rate cut relief, and NVIDIA's Intel bet lifts markets. Let's get to Yahoo Finance's Ali Canal for more on the trading day takeaways. Ali.
Yeah, Josh, well, that was certainly my number one takeaway. Records, 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 and it just feels like the market has a lot of momentum right now, especially after the Fed delivered its first interest rate cut of 2025. And what's interesting is that even heading into the meeting, we saw a lot of bullish optimism already on the street. We saw price target raises from Wells Fargo, Deutsche Bank, Barclays, among others, and they cited the expected Fed easing. They also cited resilient earnings momentum, the fact that we have AI boosting a lot of this market, and I think the moves we saw with NVIDIA. Intel was very evident in that. And then there was interesting data from Truist strategist Keith Lerner. He's a frequent guest on Yahoo Finance, and he talked about how going back to the 1980s, whenever the Fed cuts, when the S&P is at records, 12 months later, the S&P is higher. Mm-hmm. So it seems like history is really on the side of markets there. However, at the same time, the path likely will not be linear when it comes to more record highs. And part of the reason for that is that right now, the S&P looks fairly valued to some strategists out there. We are trading just above 6,600. A Citi strategist, Scott Kroner, he has a year-end target of 6,600. So at this point, he doesn't doesn't see the risk reward fully balanced out there, and that has been quite a bit of commentary that I've been reading. Also, there might be some exhaustion in the tech-heavy index, the NASDAQ, the NASDAQ 100 as well. You are seeing how aggressive that run-up has been, up over 16% since the start of the year. And Evercore ISI, Julian Emanuel, he's very bullish on tech over the long run, the AI revolution, but he says when it comes to volatility, there's nowhere to go but up here for a lot of these names. So just something to look out for as we continue to look for more record highs.
Should we end here on crypto?
Let's end it on crypto, baby. I mean, crypto just continues to gain steam here, and there's a few reasons why. Obviously, we know that this administration has been very crypto friendly, but rate cuts also help that story when we talk about the risk on picture. We've seen a consolidation of around $115,000 a coin when we look specifically at Bitcoin, but we've finally been able to break above that. And again, the catalyst there being the Fed, and 120, that's been a level that we've struggled to really hit and be sustainable, but we certainly are on a good path forward. We also saw that the SEC streamlined some regulations when it comes to crypto exchanges. So yet another tailwind for Bitcoin, for Ether, for a lot of these altcoins as well. So it feels like we might be finally getting into a crypto bull run, and we can have sustained upward momentum here and maybe hit some more record highs.
All right, thank you, Ali. Appreciate it. Stick around. Much more Ask for a Trend still to come. The Fed delivered its first rate cut of 2025, lowering interest rates by 25 basis points and seeing more cuts coming for the rest of this year. Chair Powell framing the move as a risk management cut, underscoring that while inflation remains elevated, job gains have slowed. Here to come through what comes next and what it means for your personal finances, let's get to Concurrent Wealth Management founder and wealth advisor Preston Cherry. Preston, it's good to see you. So the Fed cuts, Preston, and I'm sure some viewers are thinking, you know, when am I, as a consumer, going to see the impact of that? What do you tell them, Preston?
Well, I'm telling them that the business of borrowing is still expensive, but the business of investing is spot on. I mean, right now, the portfolios are doing well. However, the pocketbooks are being stretched a little bit. I mean, we're in a bull run as far as the market is concerned, but the economy is like a bunny. It's just bouncing along a little bit. I mean, it's kind of lukewarm. You know, as you mentioned, jobs are tepid at best, and inflation is still a little elevated at 2.9%, almost 3%, almost a full point over where the Fed wants it at 2%.
How long does it take, Preston, for a Fed cut to trickle into the financial products a lot of us depend on, you know, mortgage or credit card loan?
Well, it's important for folks to know that the Fed can only signal interest rates, and the market really sets interest rates like mortgage, demand for example. And right now, mortgage rates have been trickling down a little bit. I mean, right now, mortgage rates are at 6.35, something to this effect, and its supply is starting to loosen up a little bit. But at any given time, with tariffs, that could choke supply again. I mean, it's really sensitive right now in the housing market where anything could set interest rates back up. That said, the bond market is more of a telltale sign of how interest rates are going to be in markets like HELOCs, mortgage, and the like. But as long as the Fed is signaling loosening the interest rates and signaling future economic, conditions, then those rates, like I mentioned, HELOCs, mortgages, and credit cards and the like, then borrowing could not elevate as much and stay in a range that people can manage.
Preston, what about those folks listening right now? They're focused on savings, retirement. How do rates play into it for them?
Well, again, rates are good, or markets are good right now for those that are talking about retirement, because if people can stay committed and separate Wall Street from Main Street and then your street, those are three different streets. Wall Street right now for portfolios are doing great. So if you can stay committed to a consistent investment plan, then you can take advantage of those compounding returns at any life stage that you're in. If you're young, then you have a lot of time. Gen Xers, for those that I serve, then you have to increase that savings rate because retirement is right around the corner, and a lot of Gen Xers feel behind. Main Street, it's the economy, and refrigerators and big ticket items. That's where those prices where you can feel the big pinch. And then your street, those are budgets, those are career choices, because right now jobs are not being added that much, and then when jobs are being displaced at companies, particularly those jobs that are high income, companies are not replacing those. So again, that's a sign for companies that are saving at the balance sheet, which is increasing companies' portfolios, but not very good at the household level, meaning your street.
Preston, speaking of your street, I mean, for those who want to invest, broadly, Preston, what are you advising in terms of crafting a portfolio against this backdrop in this environment? Well,
I know people don't like this, but you got to stay diversified. Boring is the still sexy, right? Meaning stay diversified across portfolio, so you won't get jammed up into one or two stocks. That said, you can also take advantage of volatility that may come. Those headwinds to where headlines that may come, or news that's short-term volatility, or economic unrest that are uncertainty that may come. Remember, I said that this is a bunny economy just hopping along here, and any type of uncertainty that comes, that you may have a shock to the market, and you have that opportunistic investing, then those are the times where you have cash on the sidelines to where you're not panic selling or panic buying, but you do have those pre-planned pockets of money to where outside of your core portfolio, you're saying, okay, let's take advantage of these opportunities.
Yep. Preston, thank you for your time today, sir. Appreciate it.
All right. Thank you.
That's a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wealth. Have a great night.